Hi, my name is Todd Berzer with Kevolve Product Management. This is Product Management 101 and our lecture on competitive analysis. In an earlier lecture, we talked about the purpose of product management. So we talked about the purpose of product management being to manage the full life cycle of products and services to create exceptional customer value, to generate long-term competitive advantage, and deliver year after year profitability. And since we're talking about competitive analysis in this lecture, let's think about the word competitive advantage for a minute. You really want to be, with your products and services, better than all the competing alternatives at meeting your customer needs. So in past lectures, we have set out the framework about the work of product management. We looked at it across 4 different areas. So market intelligence, strategy, new product development, and lifecycle management. So in this set of lectures, we've been talking about market intelligence. We looked at market analysis, customer analysis, understanding their needs. Now let's look at competition, competitive analysis. And in particular, in this lecture, what we're going to do is we're going to look at, first of all, why you would analyze competitors, why it's important as a product manager, identifying and prioritizing your top competitors, what to analyze. So once you've identified those competitors, what do you need to know about them? We're going to talk about this idea of disruptive technology, which in a sense is another form of competition. And then an ongoing process of competitive monitoring. So let's start with a question. Why would you analyze competitors? Well, there's a number of reasons. One is you want to anticipate market shifts. Now, this is a good way to do it. So sometimes your competitors bring out something new. They introduce something into a new part of the market. They have some success there. You should learn from that. There might be a broader implication in terms of where the market is shifting. Okay, second one is your competitors are going to come up with a lot of ideas how to improve their products and services. You can learn from that and improve your own products and services. You also want to spot early the emergence of any new competitors that might pose a threat to you. You also want to know about your competitors so that you can craft counterattack strategies, so that you can work with your regional marketing, with your sales groups to develop programs to directly attack your competitors. And since pricing is closely linked to profitability, you want to know what your competitors are doing in terms of pricing and where you have room to maneuver or not. So it's important to understand your competitive pricing. And finally, there may be a competitor or two that come in and offers products and services much different than yours and are very successful. You may need to change your strategy. Lots of reasons to analyze competitors. But which competitors to analyze? You need to identify and prioritize your competitive set. We're going to do this in 3 levels. So the first one, let's start at the bottom, direct competition. So these are the people you probably know very well, or the companies that you know very well, that you're directly competing against. You've got very similar products and services. You meet them in the market with the same customers and the same channels, whatever. And just as an example, I'll just use an example from my own background. I worked for a number of years at HP, at Hewlett-Packard, in the product management group, bringing out color laserjet printers. So our direct competition in this case was Xerox, Samsung, Brother. They all had color laser printers that competed directly against us. And then there's category competition. So, closely related categories that compete with your product category. In the case of the printers that I was working with, there was inkjet printers that could also do very similar things as color laserjet or color laser printers. And then there was color copiers that also printed as well. Category competition. And finally, this one we're going to talk a little bit more about later, but that's the idea of substitutes, market evolution, or disruptive technology. So customers can meet their needs. This is what happens. You see this when customers meet their needs with alternatives or new technology that are pretty fundamentally different than what you're offering. And as an example, I talked about with HP and our work on color laserjet printers. You can think about our direct competition, our category competition, but at the end of the day, we were in the business of putting information on paper. But if people start to get their information, read their documents on a smartphone, on a tablet, on a laptop, that becomes a disruptive technology. They're actually not putting it on paper. So that's an example of a disruptive technology with color laser printers. So what do you analyze when you're looking at competitors? What if you've identified your competitors? What do you look at? What do you dig into? Well, first of all, you should know your market share position and what are the trends. You need to know about their strategy, where they're putting their investment dollars. Are they putting it into channel development? Are they putting it into research and development for new technologies? Where are your competitors' focus? What's their target market? Is it exactly the same as yours? Is it a slightly shift? What's their strengths? What's their weaknesses? What's their technology position? Do they have particular patents that are expiring? Are they putting a heavy emphasis on technology development? What's their technology position? What's their pricing? Are they higher than you? Are they lower than you? When you raise your price, do they follow? Do they lower? Do they not even respond? What's their pricing strategy? What's their channel strategy? Are they going through retail? Are they selling direct? Do they have sales force? How are they getting to their customers? And then finally, what's their reaction pattern? When you make a move, do they make a move? What is their pattern? If you raise your price, do they raise their price? If you lower your price, do they lower your price? If you open up a new channel, do they open up a new channel? What's the pattern of reaction? You need to know this so that when you look longer term, you can kind of map out when you make a market action, how this reverberates with your competitors and how it kind of plays out over time. And you can map this all out on a table. This is a nice summary table. You can put yourself on this table, all the factors that we just talked about on the left, and then compare yourself against competitor A, competitor B. It's a nice summarized way to do this. You can also add some graphs. This is, I think, is important somehow to capture the information. Here we've got an example graph of market size and share. In this case, your company is in the blue. This is your market position. This is your share. This is your revenue per year, or your sales per year. And then what is up with competitor A, competitor B, and you can see a number of things from this market, including the size and shape of share, as well as the direction of the market growth itself. Okay, an example of a way to present your data. Let's talk a little bit more about disruptive technology. These are innovations in products and services that fundamentally alter market demand. And often long-established companies, you might be one, can lose their market competencies. They can lose their market dominance. And there's some risk factors in this. So you have to think about your own management teams or maybe yourself. There can be management denial, there can be resistance to change, and a funny one, high profitability. But if you've got very high profitability, it often makes companies blind about what's happening in the market and resistant to change. And sometimes lack of imagination. A classic example of disruptive technology is the company Kodak. Now, it depends on your age, but you may have grown up taking pictures on film and then sending those off to be developed or taking them somewhere to be developed. Maybe you just worked with digital cameras. Kodak, for a long time, made a lot of money off selling film. And I think, and they had just a dominant market share worldwide. And I think in the US, they had, in 1976, they had 89% market share for the film market. Very high profit product for them, very, very wonderful business. And about that same time, I think 1975, they developed digital photography. They were the ones that developed the initial technology behind digital images and digital photography. They decided not to pursue that market. They decided we just love our film business so much, let's just sit on that other technology because we can't see kind of that revenue stream coming out of it. At least we can't envision that. And eventually the market overtook them. They lost their lead. They lost their film business. In fact, last year they filed for Chapter 11 bankruptcy. Now they're still around. I hope they do well. But it's an example of a company that was extremely well positioned to move ahead on a disruptive technology, but decided not to pursue it and let the disruptive technology take over their business. So the bottom line on this is product managers, if there's risk of disruptive technologies, you need to highlight that as part of your competitive analysis. And I just noted there's a good class on Coursera on this one, Surviving Disruptive Technologies. You might want to take that. In terms of ongoing competitive monitoring and management, you need to think about this in three different buckets. So there's kind of a continuous activity that you do as a product manager to keep track of your competitors. This is the continuous part. So if they come out with a new product or you hear about a new technology that they're developing, that's just stuff you need to monitor on a day-to-day basis. And then there's this periodic time when, maybe every 3 to 6 months, where you do some in-depth analysis. You look at those tables, those graphs that I showed you earlier, you update them, you fill them out, you do your analysis, you present them, and that's on your key competitors as well as maybe your second-tier competitors and disruptive technologies. That's the periodic place, or periodic analysis. And then also there's a project-based analysis. So if you've got a competitor, if you've got somebody that's become extremely successful or introduced a new product that you want to know more about, there might be a periodic or a project-based analysis that you do. So kind of those three steps you can walk through and keep your competitors monitored. Now, over the past lectures, we've been talking about market analysis, customer analysis, and now competitive analysis. This is all tough stuff. This is all very difficult to do. And at Kevolve Product Management, we're very strong proponents of this idea of the flipped classroom, so that you can, and the idea of the flipped classroom is you take online classes like this, you do it on your own time, and then together with your teams, you work through how to implement this, how to customize all the tools and the approaches that we're suggesting in with your teams and customize them for your particular business. And that's a tough process. We can help if you would like. We do training, we do workshops, we do consulting and coaching for product managers and product management leaders as well. And you can contact me, my email address is there. So that's competitive analysis. Just as a review of concepts, we looked at reasons to analyze your competitors. We looked at how to prioritize your competitors. We talked about what you need to know for competitive analysis, talked about disruptive technologies, and then about establishing a system for competitive monitoring. So next up is strategy development, and we will talk to you then.